Hey traders, what is going on? It's your boy Luke here from ZCFX Trading as always. Now in this video, or masterclass should I say, hey masterclass, we're going to be discussing market structure. Now the reason I chose market structure is because I put up a poll on my Instagram story. I don't know if you guys seen it. The first poll was, who are my following are beginners or advanced traders? And it seems like the majority of my traders are advanced traders. So congratulations, that says something. That's pretty cool. I will be releasing beginner videos in the future as well. I plan on doing a 3-part mini series for the YouTube, so that'll be something to be excited for. I also plan on doing other things as well for the advanced people. So for those of you guys watching this video, I will be going over the basics of this. So I am going to be starting off with the basics and heading into the advanced as we progress with the video. And yeah, I ran up another poll. I said, what is something you struggle with? And a lot of the answers seem to be around market structure related. Where I thought it might have been liquidity, like PY identification or risk management, but it turns out it's market structure. So here I am, gonna help fix all your structure problems, guys. Okay, and any questions and things like that, I'll jump into where you can contact me towards the end of the video. But don't worry, I'll have you covered. Me and my team will sort you out. Moving on to the first slide, let's jump straight into it, guys. Here's the video overview. There's a lot to get through. We have all this. I won't sit here and read it to you guys, but there you are. You can go ahead and see it for yourself. There's also some bonus ones on there. Trade recap, market phases, anticipating pullbacks, exclusive discount. Contact me. By exclusive discount, guys, I have something very, very exciting that I'll be releasing to you guys at the end of this video. I did leak it once on my story. I'm not going to mention it again until the end of this video. But it is in fact something I'm launching and I'm very excited. I've been working on it for a while. It's going to take over the industry, so I definitely recommend you check that out, guys. Just stick around and just wait. Personal introduction. So I won't dive into my entire life story, like my dad was into this, my granddad was into that. But here's a little bit about me. My name is Luke Taylor. I am from the United Kingdom and I'm 24 years old. I have been trading since 2016, so I can confidently say I've been in the markets for nearly a decade. Or as Errol likes to say, shout out to Coach Errol. If you haven't seen the ZCFX Errol Instagram, go ahead and check him out. He's a coach in ZCFX as well. And he calls me a fossil in the industry. I don't know whether that's a compliment or whatever. We'll see. But yeah, apparently I'm a fossil. I've been in the markets for a while. Obviously, average trader who just spawned out of nowhere. I started creating content or Instagram posts. They've probably been in the market, so I've most definitely been in the markets for not even a year, max 2 years. So when it comes to experience, I'm the man. Nice to meet you guys. I'm Luke. But anyways, this time has flown by. It doesn't feel like a decade at all. Well, nearly a decade. It just feels kind of a flex to say nearly a decade, even though it's not nearly a decade. It's a couple of years off a decade. But the time has flown by. It feels like 2-3 years, when in reality it's like 8 years. It's pretty crazy. But again, at the end of the day, I suppose that's what you do. That's what happens. Sorry, when you love what you do. So pretty much it, really. I've been funded multiple times as well, and I received numerous payouts along the way. With my first one in 2020 with FTMO, I jumped on social media around 2019 as well. So if you scroll all the way to my Instagram, you'll see posts back in 2019, maybe even 2018, but I think it was 2019, 2020 time. But you'll see posts from like 4 or 5 years ago. So I've been around a while. I've experienced and felt all the emotions that you have when it comes to trading as well, so therefore I can massively reduce your learning curve when it comes to creating these videos, or putting out tips here and there, or telling you guys what mistakes to avoid. Make sure you do this now, because I've been through a lot of the emotions that you have, so I can definitely resonate. And I've been there, I've done it all, so definitely resonate with you guys who are feeling a certain way around trading, because I've most definitely felt that, feeling too. Whatever it is, from pressure to being down to feeling euphoric, through all the emotions, the ups and downs. I've been through it all. And obviously, because I teach people as well, so I've had thousands of students coming through my doors. I've spoke to thousands of different traders, and it's so amazing to speak to all these different traders from around the world. It really is. But yeah, I got a lot of experience. I spoke to a lot of many different traders. I've answered a lot of people's questions, so I've got quite a lot of knowledge up on this noggin. But anyways, during my first few years of trading, I often felt like quitting or wondered what is the point of all this, and you probably have too. So again, guys, I resonate to you, don't worry. But besides trading and running ZCFX Trading, I have always had interest, and I do hobbies in these guys as well. is the gym, arm wrestling, rugby, golf, gaming, networking, relaxing at the spa. There's probably a couple I missed out as well that I like to do. For example, like I'm into cars, but I didn't put that on there, right? But if you have interest in any of these, then you know I'm a pretty chill guy. We'll probably get along anyway. You know, I'm easy to get on with. You know, I'm chill. Anyways, moving on to the basics of market structure. So the theory behind market structure. So market structure is the behavior, condition, and the current flow of the market. Market structure represents swing highs and swing lows. These are just some basic notes that you can write down. A trend is simply a consistent direction of price movement over time. Market structure can tell you if the market is trending or not, like trending or ranging. In a bullish market, there are higher highs and higher lows, and in a bearish market, there are lower lows and lower highs. Okay. In a bullish market, when price creates higher highs, it is breaking structure above previous highs. The word breaking structure, keep that in mind because we'll be jumping into that later. Vice versa, in a bearish market, when price creates lower lows, it is breaking structure below previous lows. Here's an example of market structure. This is the absolute textbook. I will be going into some more examples as well. But this one, as you can see, we've gone from bullish to bearish. And as you can see, we're creating higher highs and higher lows. But as you can see, in order for it to be a higher high, it must take out a previous high. In order for it to be a lower low, it must take out a previous low. When price starts to take out previous lows like this and creates lower lows, then it's a bearish market. Vice versa, when price creates higher highs, takes out the previous high, then it's a bullish market. Okay. Now, here's the market structure basics as well again. So this is more so expectation versus reality. So as you can see here, even on the previous slide, we've gone over this. That was just to help to explain the logic. It's a little bit more complicated when it comes to the actual live market, because obviously price won't move like this. I mean, yes, there is a line chart, but it won't move like this. It'll move a little bit more like this out of the two. Maybe even more complicated than this. But the ideology is just, this is just the ideology to explain to you, okay? But obviously in the live market, it's a lot complicated. It's a lot more different to identify these swing highs and lows in the markets. That's why I come up with a rule-based system, which we'll jump into shortly. But as you can see here, guys, we get a lower high, lower low, lower highs, etc. A bit of consolidation here. And yeah, pretty much is all there. As you can see, that's the market for you. Anyways. Bullish market here as well. You can go ahead and look at the expectation versus reality. Okay, so as you can see, it's a little bit different. You into this move here, you know, it's not going to be a straight line from A to B. It's more so going to be, may move down then up and then down and up again and then down, and it may come back down. Respect, you know, not take out the high, but well, the high low in this case. And then it move bullish and go eventually take out the highs. Okay, so it's not really going to be like a straightforward line from A to B, is what I'm trying to say. Now, when it comes to mapping, so you're probably wondering, how do you actually mark up market structure, identify the high or low in the markets? There are two ways you can map out market structure. You can either follow the traditional way, in which for a swing high, you must locate the highest point that broke the previous swing low, and vice versa, for a swing low, you must locate the lowest point that created the pullback. Alternatively, to simplify things to the fullest, I created a rule-based mapping system which revolves around locating just 3 candles, in which the middle candle wick must be higher than the candle to the left and right of it as well, which would be your swing high. Vice versa, the middle candle must be lower than the candle to the left and right of it. So we'll jump into some examples now. So as you can see, okay, it's 3 candles, and as you can see, this middle candle is higher than the candle to the right and higher to the candle to the left. So that would be a swing high. Okay. What I'll do is I'll jump onto the charts. Before I do, again, this is lower than the right candle on the left candle. Okay. But what we'll do is now we'll jump onto the charts and we'll go over to some examples. So looking at the daily here, just start off. Let's go here, maybe. Yep. No, let's start off over here. Let's start off at the top over here. Okay. I'm just going to start off with explaining through it, and then I'm going to speed run through the rest of it. Now, when it comes to using multiple time frames, like for example, you can mark out this high and this low here, right? And on the lower time frame, it may be telling you something completely different. Okay. So for example, if this is the daily time frame. So this is, I do use the weekly sometimes, but I mainly use the highest time frame as my daily now, as I don't really use the weekly so much more. But if you mark up the daily range and the daily range is bearish, and you drop to the 4 hour and daily range is the 4 hour range is bearish as well. You drop to the the 15 minute and the 15 minute range is bearish as well. That's going to be high probability to be traded from, as opposed to daily being bearish range, 4 hour being bullish range, 50-minute being bullish range, for example. Okay, you can trade in anticipation. So something like, for example, when price is overextended at this point, as we just broke structure and sweep liquidity, you can expect a pullback. Okay, so we'll be jumping into that later, but you can expect a pullback. And obviously if the low time frame chocks as well, you can expect a pullback. So it's okay to be trading directly against it like that, but when price is in the premium side of the pricing, like above this half, which we'll be jumping into the premium discount later, it's better to be trying to stack all the confidence together, so like aligning the time frames together. But anyways, here's how you map up structure. Okay, so we're going to start off here. As you can see, price is bullish, right? We're overall making highs and high lows. But as you can see here, we break structure here, we get a new high, we follow price back. Again, that's the key, we always want to follow price back. We then map to the left. This is a wick. This is not a valid structure break. I'll be jumping into structure breaks very soon and explain why, but for now this is not a structure break, just simply because of that. Okay, because it's wicked it. We need to see a body closure like this. We have a new low because price closed below this previous low. We then follow price back, we have a new high. Okay, as you can see, price just wicks out these highs. We don't get a closure above, indicating potential downside movement. We then get another break of structure to confirm the downside move. We then follow price forward, we get this low here, we follow price back, we get the new high. Okay, as you can see, again, we break structure here, we follow price forward again, we get a new low, we got the new high, slight break here, we get a new low, new high, break structure here, new low, new high. Now as you can see guys, this is sometimes insanely precise. As you can see, this here is a clear mitigation of an order block. Obviously, probably some of you watching this don't know what an order block is. You can go ahead and check out my YouTube on supply and demand. If you don't know what it is, there's a lot of information on my YouTube. But for those of you that do, that's a clear mitigation there. Whereas if you mapped out structure using the traditional ways, where like the highest point, I used to use that as well, but I changed to this because that was a bit complicated, and I noticed myself. I noticed this happening in the markets using this 3 candle, so that's why I use it. Like I actually back tested this for a long time, probably like a year in total. Like from I think it was from like 2020 to 2021 is where I literally just like back tested this and studied it and researched it. And because the traditional way is obviously the highest point before the lowest break, whatever, or like the lowest point before the break high or whatever. But like this here, right, would be your high, and then this here, for example, would be your low, and you'd still be waiting for a pullback into all the way up here. So you missed out on a lot of trades like this here, mitigation, this here, the mitigation, the potential break or unbalance fill. There's a lot of opportunities to just adapt into the ranges like that. So if you map it up this way, you definitely see yourself getting into a lot more trades. Obviously, you got to filter them out to be winning trades. As you can see, we've got the low, we've got the high. Okay, price doesn't close above, we wick it. We move down to the downside, following the bearish trend. So obviously, this is all bearish structure, right? We get a new low, follow price back, we got a new high. Okay, we break structure to the downside, we got a new low, we follow price back. Now we don't have a high here, but we've got the same high as the previous high. Okay, which is all the way up here. Now again, we can trade internal structure. For those of you who know what that is, you can trade internal structure at this point. You can even trade internal structure around here as well, or around here. When you're anticipating like pullbacks to happen, you can trade internal structure to lead up into that potential POI where you're looking to trade from. Or you can mark up premium discount, so anything above here to sell, anything below here to buy. So you can trade, buying into that sort of sell area. Again, we'll be jumping into premium discount soon if you don't know what that is. But again, in this case, as you take out these internal sort of potential highs here, you can trade internally leading up into the overall POIs. And obviously, if it breaks, then it's what it is. But as cliche as it sounds, the saying goes, the trend is your friend until it ends. Okay, so what that means is you want to be taking most advantage of looking for sell within this whole bearish trend. But because it's now ended and we potentially flip bullish, it's it's like they say, trend is your friend till it ends, right? Anyways, as you can see here, we get a break structure flipping bullish potentially. Okay, we have this high, we go back, we have low. Okay, we were in this range. Now mitigation, I won't jump into that what it is just yet, but you can check out my YouTube. We then break above this high here, previous high, so we got a new high, we got a new low. Okay, unfortunately price breaks back bearish again. We don't close here, we close here. Okay, so that's the break. This is not the break because we don't close with the candle body we need to see a candle body closure, as that is a structure break. I'll be jumping into that later. But again, guys, sometimes like this, like it'll go like, we may move like this for a bit and then we'll chalk and then move back bullish. A lot of the time it's just a liquidity sweep or something going on the high time frame. Like this here on the weekly, this might be your range high and your range low on the weekly. So that's what I was trying to say earlier. Your range, like this here, for example, this could be the range high or low on the weekly. This low and this high is the range on the weekly, which explains this pullback into this area here because of the weekly time frame. So that's the importance of using multiple time frames, and obviously having a good understanding, because when you know, map out like this, you know, sometimes that will happen. Like it'll, you know, this may be a chalk here, and even though you could get a nice buy opportunity here, you got to break structure. You may be looking for buys around here and you may take a potential loss. Even though taking losses is fine, just understanding, like if you use multiple time frames and align up the structure together, it's better to do that rather than just trying to guess based on the one time frame, if it makes sense. You can definitely take advantage of the multiple time frames, mark out the weekly range, mark out the daily range, mark out the 4 hour range, and just see where price is at. Obviously, the high time frame always rules, so you want price to be in the premium side of the daily. You know, if you've got the daily range, the H4 and the M15 range marked up, and you got the premium discount, you want to be selling in the, you know, in the bearish range on all time frames inside of the premium side of the daily range. Like I said, we'll be jumping into more of those later in terms of the individual concepts and the trade recap as well. Anyways, go back to this. We chalk bearish to the downside again. I believe the chalk is here. Okay, yes, the break. Just to double check, and we get a new low. We follow price back, because remember, you always want to follow price back. We get a new high here. We then break above here. We got a new high. Follow price back. We got a new low. Okay, mitigation. We take out the structure high here. We then have this new high. We got this new low. Okay, we then wick this area, but we break structure to the upside. We have a new high. Follow price back. We got a new low. Then price wicks out this here. Potential again, when price wicks something like that, that's a significant wick sweep. And if the price chalks on lower time frame, so for me the 50 minute, well the 4 hour, then the 15 minute, I'd jump sometimes straight to the 50 minute as well. I don't grade my setups in terms of A, B, C setups, but I do lower my risk depending on the probability of the setup. Like this here would be a lower probability as it is a wick sweep and it's counter trend compared to, you know, looking to buy this bottom half of the range higher low. Because the ideology, guys, is when you have your range higher marked up, you want your POI inside of that range, and the lower the point you can get like this here, right? This is a nice zone to be trading from. So I'd wait for price to pull back into this and look to buy. That would be sometimes higher probability as opposed to looking to sell on a counter trend. But when it comes to high probability and low probability setups, it doesn't necessarily guarantee you're going to be on a win position if you take a high probability setup, because you may like mark up the charts, say to yourself, oh, this is the highest probability trade that I potentially ever seen, but then it still take a loss and it'll fail. Okay, that's just the reality of trading. That's just what happens. But that's what I'm saying. Based on high probability, if it's a high probability setup, it doesn't still guarantee you the winning trade. Okay, but the highest probability trade is just more so when the confidence is match up, and it's all followed to the T pretty much, and everything's in line with each other, etc. Okay. Obviously there are reasons why this low didn't go on to work out and hold. For example, as you can see here, well, no, it did actually, sorry, we wicked it. Okay, so as you can see here, we've got this low, we follow price, we wicked it, so that's potential buy there. That's a very nice. I'd prefer to be buying on this wick sweep here compared to selling on this wick sweep. But even though I would sell on the wick sweep, I'd prefer to just be on the buy side. But you can take both, because why not? If the confidence line up, sure. Now, this is all internal structure. We do get eventually a breakdown here. Okay, we have a new low and a new high, and we're stuck within that range currently right now as of live, like today is 24th of July. That's the current range, so I can't go any more forward. But hopefully this way of mapping structure has made it make sense to you. It's just you're following price, okay? And there is homework for you at the end of the video which will help you with the mapping process. But just understand that for now, okay? And if you want to jump onto the charts, you can do. Just follow this way of mapping structure. It's so simple, guys, when you follow it, really. You don't need to complicate yourself. When it comes to mapping structure, a little bit of a tip, guys. Don't, obviously, if we just pretend that this didn't break out the range and we're still inside the range, if you just pull up the charts and you map up the high and low, well, you may think to yourself, okay, this is the low, this is the high. Like, even though it is, that's an internal range, high and low. That's something we'll jump into later, internal structure. But it's important to start out to the bit to the left, What I mean by that is build a narrative with your structure. Okay, don't just start with your most recent bit of price action. Start a little bit back, go back a couple months if you need to or whatever, and just build up a narrative with price, mark up the highs and lows, because this here, like, this is a great example of it. This is the range high, this is the range low. This is all external range high and external range low. Everything inside of this range is considered internal structure, but I'll be jumping into internal structure later on, okay? But just keep that in mind. So you don't want to be trading inside of this thinking, okay, well, blah, blah, I'm looking for this and this, because you just marked up the recent bit of price action. You need to start back a little bit and build a narrative, okay? But that's pretty much how you map up structure. It's very simple. I've thrown in a couple of gems here and there as well. But again, I'll be jumping, if it's one of them, it's just a simple concept. You don't need to overcomplicate it. I'll jump onto the 4 hour time frame, and we'll just take a quick look, and I'll just speed run it so you guys can see, okay? But we'll just start off here, okay? Range low, range high. We break structure, we have a new range high, we wick sweep, potential sell there, we pull back, nice mitigation, cool, okay? We then take out this high here, we get a new range high, we get a range low, okay? Cool, price falls back, mitigates this imbalance here, cool, continue bullish. We take out this high here, we have a new high here, and we have a new low. Unfortunately, price sweeps out this low, but obviously on the high time frame, the daily more specifically, it'd be already within this range down here. So it wouldn't be a chalk. And remember, chalk, I will teach you guys now, if those of you who don't know, chalk is unconfirmed trend, BOS is confirmed trend. So it's better to be trading from a breaker structure as opposed to just a chalk and then a pullback. So even though this is a chalk here, it's better to wait for a price to break structure and then pull back again, rather than jumping, wait for a pullback and jumping straight to low time frame, looking to sell there. Okay, it's high probability to wait for another structure break just to really confirm it, especially the way that we map up structure. But as you can see here, we get a new range low, we get a new range high. We break structure here to the downside, upside, range high, follow price back, we've got a range low. We obviously pull back, we get a wick sweep there as well at the top, potential sells. We wick out this, or we take out this low here, we close below it, we get a low, we follow price back, we get the high, okay? And another little bit of advice, guys, if you're ever in doubt, zoom out. It's one of my number one bit of advice, my motto. If you're ever in doubt, zoom out, stick to it. Range high, range low. As you can see, pull back, mitigation, very nice, okay? Again, don't expect it to always work, guys. Like this here, you may be doubting yourself if this happens and chalks again, probably gonna be doubting yourself, but just don't, okay? Just stick to it. It's a consistent way of mapping structure. You get yourself into so many more positions, and it actually gives you more confidence knowing that you can map a structure this way, because there's actually a rule-based system behind it, rather than just blindly trying to locate the highest point and the lowest point and then waiting for all these extreme pullbacks, which takes days and weeks to pull back. Just do this. It's so much better, guys. It's so much better. And I've designed this, spent years on it. Just do it. It's amazing. And again, if you're ever in doubt, zoom out. So if you can't feel like you can locate this range high or low, obviously if you're in my mentorship, then you can put it in a chat and I can correct you. But if you're not in a mentorship, then I can't really help you. So I definitely recommend you check my mentorship, because I've created rule-based systems for a lot of the concepts that I teach. So I definitely highly recommend that you check out my mentorship, guys. And especially this thing I'm about to launch at the end of the video, it's going to be crazy, I promise you. But as you can see here, we break structure to the downside again. Range low, we go follow price back, range high, slight pullback. Take out the lows, okay, we get a new range low, follow price back. This one's a little bit tricky, like if it's one candle like this, it would still be a valid range high or low, but you can sometimes refer back, okay? If you're ever in doubt, zoom out, or if you ever feel like this is not a valid range high, just refer to the previous one, okay? Either way, price worked out this high here, and price worked out this, well, it didn't work out that high, but I would mark up that one, what price worked it, potential sell there, okay? We then, we closed below here, sorry, range low, range high, but again, your ranges should have imbalances ideally, okay? Sometimes you might not be able to get that, but ideally your range should have an imbalance. So this here is all lower probability as a range itself. It's more considered a flat market. It's not really a nice market to be trading. It takes break structure downside, we got a new low, follow price back, we got a slight high there, or if you're in doubt, just use this one. Slight pullback. We wick it, so potential buys there, short-term ones leading into this POI here, because obviously this is still considered internal structure. Okay, this is all internal structure. Even though I wicked it, it's still internal structure. As you can see, we close below here, we get a low, we follow price back, we get a high, we chalk here, we get a new high, follow price back, we got a new low, We break structure again. We got a new high, new low, break structure again. I don't know what we're doing here, but that's the, oh no, we wick it. But that's the current bit of price action. If we wick it, we can look to sell down into this area, and then obviously if price was going to continue the bullish range, when you see price move bullish from this area here. If we don't, well, then we move bearish. Simple as that. And yeah, that is pretty much it when it comes to mapping structure. I don't want to spend hours and hours and hours just going to like put charts with you guys, because the only way that you're truly gonna like really get it is if you jump to the time frame charts yourself and actually start trying to map it up. And there is a bit of homework at the end of this video, so make sure you stick around for that, because it'll help you, because I'll help you as well. But that's pretty much how you map up structure. So let's resume with the video. Okay, so moving back onto the video, guys. That was how you map up structure. Hopefully you guys have took a lot away from that. It's very important you listen up to it. Moving on to premium discount. You probably heard me mention a lot of these concepts we're about to go over in the video already, but I really wanted to, let's just jump into it. So premium discount is a simple yet effective tool to help validate points of interest. You'll learn more about these later. Well, point of interest probably not in this video, but point of interest is essentially just order blocks, breaker blocks, imbalances as well, or typically known as fair value gaps. Those are sort of the top point of interest, and point of interest is essentially just what you trade from. Okay, and you can trade from them. I've done a video on that already on YouTube, which is just supply and demand. Go and check that out. If you need a link to it, just DM me and I'll send it to you. But a lot of value on there as well. As with anything in life, we all love a good deal or a good bargain or a good sale. Okay, if you've seen an item on sale that you were previously interested in, you're more inclined to buy it because it's now on discount. Like, especially if it's like a 50% discount on your favorite pair of shoes. Hell yeah, who doesn't love a good discount? For example, if you find like a car that you're interested in or you like, it's a little lower price, but you come back a month later and it's still listed, but it now has a clearance discount because no one's buying it. You're most likely be inclined to buy it because you wanted it previously. Obviously, you've still got the cash there. Premium is the amount that you paid above the average or basic price, and obviously the discount is a price less than the average or basic price. In trading, we use a tool that helps us locate points of interest in the premium or discount based on whether we are buying or selling. If we are selling, we want to sell inside of the premium zone. Vice versa, if we are buying, we want to buy inside the discounted zone. We use the tool Fibonacci retracement, but rather than using the typical settings, we focus on just the one, which is the open, or it doesn't matter which way it is, but the 1, 0.5 and a 0. Okay, so those are the three numbers you want on your Fibonacci. It looks something like this. So you go over to the Fibonacci on the left side of the chart, pull the Fib retracement, draw it on the chart, and then just click on it and then click settings, go on style and put in 0, 0.5 and 1. The top half is premium, the bottom half is discount. You basically want to be buying in the discount, and you basically want to be selling within the premium. So in a bearish market, you want to be mapping up your structure. Obviously, in a bearish market, your range high lows, it's going to be creating low lows, etc. So when you have that range high low, you map up the premium discount. And in the top half, you want to sell from that in the top half, obviously if it's in the bearish range, and the vice versa with price in the bullish range, you want to be buying within the bottom half of that range. It's just a general rule of thumb. Sometimes it won't always pull back fully enough into the discount or fully enough into the premium side, but that's the general rule of thumb you want to follow. Now, how we know to mark up our trading structure and ranges and structure, I want to jump into premium discount. Okay, so like I said, we already know how to mark up structure, so that's cool. That's all good. There's a couple of examples there you can look on while I talk. But in a bearish trend, you mark up the swing high to the swing low. In a bullish trend, you mark up the swing low to the swing high. In a bearish trend, we want to sell above the 50% retracement in premium. In a bullish trend, we want to buy below the 50% retracement in a discount. Okay, as you can see here, price is bearish overall. So this is the range high and this is the range low. We want to be selling within the top half of the range, ideally. Okay, just because that's the premium side of the range. So it's better to be selling up here rather than selling above here. So when it comes to POIs or points of interest, and you have all order blocks, so order block would be here, order block would be up here. If you have two to choose from, it'd be better to trade from the order block up here, simply because the one down here is just all it's lower probability. Okay, but again, remember what I said earlier, lower probability and high probability, it doesn't predict or mean or guarantee you'll win the trade if it's high probability. Okay, it could, and it sometimes will mitigate the zone down here, the low probability zone, and mitigate it and go on and respect it rather than pulling all the way back. But that's just what it is. This is premium discount. This is just something that to help you filter out point of interest if you have multiple marked up, and it's something that, you know, it works. Another example here as well, range high or low, price pulls back into the discount and it is bullish. Okay, if you know, it's just, it's not even necessarily just to mark up the premium discount just for the point of interest. It's also just for like knowing where price potentially reverse from. Like, I want to see price reverse from this premium zone because it's better for that to happen rather than a little pullback from the discounted part. Okay, so that's all premium discount is. And yeah, I'll just quickly pull the chart and I'll show you guys. Okay, so if we just go to the daily time frame again, as you can see, okay, we'll start off where we were. Okay, the premium discount is your Fibonacci tool. It looks like that. Okay, double click. I'll just show you guys a little bit everything. As you can see, that's all I have. Just 0, 0.5 and a 1. That's all my settings. If you want to copy it, you can do. All I do is mark up the range high and low. As you can see here, I'll be looking to buy in the bottom half of this range. Fortunately, we break to the downside. We get this new low, get this new high. I prefer to be selling within this top half. Fortunately, price wicks it, but that's because there's no liquidity within the range. We break to the downside here. As you can see, I just extend that. We get a pullback, and we just slightly, ever so slightly, I'll just make that more precise. As you can see, ever so slightly, by not even a full pip. What even is that? Well, it's a daily, so it'll be a pip, but you get the idea, guys. It taps into the premium ever so slightly, and then it just melts to the downside. That's the power of premium discount. Okay, so you want to be selling anywhere above this 50% interest. Anything over this line, you want to be selling. Okay, and obviously, if we were to flip that, anything below this line, you want to be buying. That's all premium discount is, guys. Okay, again, sometimes it won't always pull back into the premium, like this here. It didn't pull back. Okay, but we just adapt. It did this one. It did the next range. That's why if you can adapt to market changes well, you will be profitable. Because if you fail to adapt, you'd still be focused on the previous range. You'll still be waiting for price to come to the premium. But because we adapt to the market, we understand that's a new breaker structure. We have a new range high or low. It comes back and works on the next one. But because if you were self-fixated on the previous one still coming back and pulling back, yeah, it may pull back to the previous one. Like it may break, you know, structure down here, then pull back again to the previous one. But it's important to be in the moment. A lot of people focus too much on what's happened already, or, you know, focus on the past. You need to be a bit more present, have a good balance of what's left. Going back to the course, or the masterclass, sorry. Moving on to structure breaks, a little bit different, okay? I mentioned structure breaks already, but what validates a structure break is a body closure. Remember, that's what I posted. But when it comes to structure breaks, it's a very simple concept to understand. It's just necessary. It's essentially just when price is making high highs and high lows, what is it doing? Okay. If I were to ask you when price is creating high highs and high lows, so moving up in a bullish market, what is it doing? It's breaking structure. Okay. We mark up the breaker structure as BOS as well. How do you view structure breaks? I follow the candlestick body, closing above a candlestick wick, so see below. Okay. We've got the high, we've got the low. Price it breaks structure to the downside. We have a new low and we have a new high. Okay, that breaking structure there is a BOS. That's what I mark up. Vice versa, high, low, previous high, we break structure because we close above it. Look at the candle. Remember, the candle contains two things. It contains a wick and a body. A wick, if it just wicked it, that would be a wick sweep, in which you heard me refer to previously during the mapping process. But that would be a wick sweep, and we can trade from wick sweeps, you know, with anticipation to the downside or whatever. Okay, but that's a wick sweep if it wicks it. A structure break is a body closure. So structure breaks, there are two types of break structure. There's a continuation and there's a reversal. A continuation is what I refer to as a BOS. Reversal is what I refer to as a chock or a shift. Okay, mainly just a chock or a chocker boss. An example of a chock is when price is creating higher highs and higher lows, so a bullish market, but then the higher low gets broken below, so closes below. That would be a chock, and then it starts creating lower lows and lower highs, a bearish market. The reason it's a chock is because it's took out the previous high low. It's closed below it, and it's the first break of structure in the opposite direction. That's all the chalk is. The first break of structure, or first structure break in the opposite direction, indicating a potential reversal. An example of the VOS is, or break of structure, is when price creating higher highs and higher lows. So bullish market, but then creates a higher high to continue the bullish trend. It's already already got one break previously. So the structure break is 2 breaks or more, and the chalk is 1 break. So the first break, okay. Vice versa, when price creating low lows and lower highs, so bearish market, but then creates a lower low to continue the bearish trend. That's the break of structure. A chalk, bullish to bearish to bullish, change of direction. A BOS is bearish to bearish or bullish to bullish, a continuing trend. Okay, that's all the structure break is. Here is a chalk BOS example. I don't really want, well, I can go into the chart, so I'll show you guys quickly. But here's a little example as well. As you can see here, a bullish market, we got a chalk. Okay, we got a BOS. Okay. Bearish market, we got a chalk to the downside, and we just continue that. As you can see, I've marked up my range highs and lows like this. So I've got the BOS and the previous chalk marked. Structure to the downside, we break structure to the downside, we got a new low, we got a new high. If price was to break above there, that would be my chalk. If price continues to break out the low, that would be my BOS. Why? Because we've already chalked, we've already broke structure. So if we need to break above that, that would be my chalk area. Okay, vice versa. That's all why you can see all these chalks marked up. It's not a chalk because it hasn't broken above it. Okay, as you can see here, we've gone from a bearish market to a bullish market. Why? Because we've broken out this high, so we have a new high, we have a new low. Okay, we continue to break structure. Now I'll jump onto the charts and I'll show you guys the chart BOS using this bit of data we have here. So this here obviously would be a chalk because we closed below the low. This here would be a break structure because we closed below the low and we've already chalked. Break structure because we already closed below the low, because we closed below the low and we've already chalked. So the chalk is the first break structure to the downside or the upside. As you can see here, all right, bullish, chalk, bearish. Okay, a chalk is unconfirmed trend. Remember that. So sometimes it will just chalk and continue bullish. So that'll be another chalk again. Okay. Sometimes the market will do that. Sometimes the market will chalk and then continue. So it's important to be, when you're trading, you can trade from chalks. I love trading from chalks. I love to wait for a sweep of liquidity and then a shift to the downside or a chalk to the downside, then a pull back into a breaker depending on the volume, and then a kind of confirmation on a lower time frame. That is beautiful setup for me. But I do like to, it's confirmed trend when you get a break structure. But if you can, like the market will sometimes randomly chalk, right? But chalks or change of character, that's what it stands for, change of character. Chalks are only, remember this guys, you need to write this down. Chalks are only valid really if they have a PR mitigation or they mitigate something. Like this here, right? It's just, a random chalk, right? Well, not really random chalk, but like, it's mitigated something, sorry, is what I'm trying to say. So it's happened to supply area, whereas if you just get a random chalk, it's not really as high probability chalk as opposed to a chalk that's just mitigated something or mitigated a point of interest, right? Okay. Again, as you can see here, we got a bearish market. We got this low here. We got a high here. That's a chalk because price broke above it, and it's the first break of the reversal. So this is all breaker structures, and then we do get a chalk here. Okay. But again, price didn't really mitigate something. We can go ahead and look at that and evaluate it. It looks like it did kind of, but we can zoom out to the high time frame because we like to use high time frame zones. So for me, like I don't really use like the weekly POIs, but I'd use like a daily POI and have like a daily POI marked up, and then I'd wait for a chalk out of the daily POI. So that's the ideology behind our trading as well. Like if I have a daily POI, I'll drop to the H4, see how the H4 reacts, and then see how the 15-minute reacts, etc. Right? If you want to learn more about that, I'd highly recommend check out my mentorship, guys, especially what I'm about to launch in the video. It's going to be amazing. But as you can see, we chalk and then break structure, and then we chalk again. It is what it is. But then yeah, that's it really. Our other chalk is over here. Like we've just chalked bearish this week, so we'll see. But obviously, if price was to break bullish above here, then that would be a chalk. If price was to continue, just wick sweep it with a wick, because remember, structure breaks, chalk, break structure, it all must have a body closure with the candle. This is just a wick sweep, okay? But that's pretty much it when it comes to chalk and BOS. Moving on to internal structure, you hear me mention this one as well. Internal structure is very important. So internal structure is essentially where you have your market structure range marked up. That is your trading range, right? So your range high and low, that is all your trading range. And everything inside of the trading range is considered internal structure. That is all internal structure is. It may not come into play now, but it will later. Internal structure really confirms the start or the end of a swing pullback. Example of is, as you can see, we've got a range low, range high. Everything inside of this internal structure. Range high, range low. Everything inside of this internal structure. Range low, range high. Everything inside of this internal structure. Okay. This is the range high and range low. Everything inside of this is all internal structure. Internal structure. Okay. We'll jump onto the charts and I'll quickly show you guys. But as you can see, all of this here is internal structure. So internal structure is just everything inside of your trading range, because this is all external. You know, your range high is all external. Your internal structure is completely different. This is everything inside of that range, right? But you can have a range high, internal range high or low, then the external range high or low, but the internal range high is all obviously inside of the external range high or low. And you can trade internal structure. Like I'll give you guys an example now. I've been trading the DXY internal structure for a while on the daily. Even though the external structure trend was still bullish, I was trading the internal range because the price was just ranging. Okay. How did I mark up my internal range? I had this low right here, as you can see, and I followed the price back and I had this high. Price came out to mitigate this area here. I mean, it took out this low here. Internal range low, internal range high. Price mitigates something within here very nicely. So providing setups, okay. We took out this low, we had a new low, we had a new high. We then had a wick sweep here, potential buy opportunities, in which I called out with my analysis chart as well. I send analysis in my mentorship, guys, so you can compare your analysis to mine. I'd highly recommend you check out the mentorship, because I do send analysis as well on a daily basis. I live trade 2 times a week. So there's a lot of value, you know, information being flown around, and you can copy my trades as well sometimes. We break structure, or at least chalk anyway internally. We get the new range, internal high and low. Mitigate this area here very nicely. We break structure again internally. We've got the new range high and low. New range high or low. New range high or low. We break to the downside. We got a chalk here. We got a new range high or low. So even though this is creating new range highs and lows, etc., and you can still trade from them, remember it's all internal structure. Okay, that's all internal structure is. Moving back, we have market phases. So these are sort of more towards the bonuses, but anyways, as we know, the market will either be trading up bullish or trading bearish, or it will be moving sideways, which is known as a consolidation market, consolidating, or range bound market, or a ranging market. But it's essentially just where it moves to the side. So you've got trending or ranging. However, a little bit more specifically is you have impulse and correction. Price more when trading will impulse. More when trading, sorry, will impulse, and then correct, so pull back. Okay, so impulse and correction. Impulse is more of an aggressive shift, right? So impulse is a shift in structure that pretty much is just a quick movement within a short period of time. Correction comes after the impulse. It will correct itself by pulling back. Example of this is here, right? I'll quickly jump onto the charts and show you again. So impulse, this here is an impulse. Why? Because the market moved pretty quick within a shorter period of time. So that would be classed as an impulsive movement. Those are better to trade from. I often refer to these as shifts as well. Okay, that's a better market to be trading as opposed to a market that's sort of just consolidating, like this area here. Okay, but that's there as a shift, right? And what happened after the shift, or the impulse? Sorry, we started to correct. We pulled back. Okay, but that's what you can expect. And then, as you can see, when price got to the low point here, even though we didn't break it, we wicked it. There's potential buy opportunity there. We shifted again, and we started to see a change, right? And then we pull back, and obviously we started to break out of it. But that's what you can expect: is impulse, correction, impulse, correction, impulse, correction. Again, impulse, correction, impulse, correction. Okay, it's all there. Okay, impulse, correction, but we break structure. Impulse, correction, impulse, correction, impulse to the downside, correction, impulse, correction. Impulse correction, impulse. Okay, so the market when it's trending usually just sticks to that, like impulse and incorrect. It's just like where price, creates a high, that's like usually an impulse, and when price creates high, you can expect a correction to follow. And another little tip here, guys, is for the whole everything we've learned so far, when price takes out a high or low, you can expect a pullback. Remember that, okay? So if price has just taken out a previous high and created a new higher high, you can expect a pullback. And that leads me on to anticipating pullbacks, okay? When it comes to anticipating pullbacks, you want to see a shift in the market followed by a low time frame chug. These two things will indicate a potential pullback. That's all you need to know in order to anticipate a potential pullback. The reason I put anticipating pullbacks rather than trading pullbacks, etc., is because we're always anticipating what's happening in the markets. We're not actually trying to predict what's going to happen, or we don't know what's going to happen. But like Mark Douglas said, we don't need to know what's going to happen in order next. We don't need to happen next. Sorry, getting ahead of myself here. He said we don't need to know what happens next in order to make money. I said I was just rushing it a little bit there, but that's what he said. We don't need to know what happens next in order to make money. It's a very true saying. It's a very true quote. You do not need to try and know what happens next in the market. You don't need to try and predict what move is going to happen in order to make money. All you need to do is just simply react and adapt to the market, okay? And we're anticipating, remember, we're anticipating things to happen. We're anticipating price to move from A to B. It doesn't mean it's going to happen, but we're anticipating it to happen based on our analysis and our data and our information and evidence given, okay? If the market just shifted bullish and starts to chalk on the lower time frame, so the high time frame, low time frame in this case can be the H4 and the 15 minute, okay? So if the 15 minute has just shifted bullish and then it starts to chalk on the 15 minute to the downside, we can look to take a sell opportunity using our entry model and trade down into the high time frame range discounted part. Obviously, again, understand premium discount. You probably already see it's already starting to all tie in with itself, okay? If the market just shifted bearish, so the H4 just shifted bearish and then starts to chalk on the 15 minutes to the upside, we can look to take a buy opportunity using our entry model and trade up into the high time frame range or H4 range premium side, okay? So see how it's all starting to flow. It all starts to try to kind of connect. I'd recommend watching the video multiple times as well. Again, high time frame, we get a huge shifted upside. And again, there's another thing that you can use to anticipate a potential pullback is when price seems overextended. So when price is just rallied over a prolonged period, you can expect a pullback as opposed to just a short move to the upside. Okay, there's not going to probably be such a big pullback at a short move compared to, if price is just shifted massively to the upside, okay? And as you can see, we get a high time frame shift to the upside, we get a range high and low, then price starts to break to the downside on here, on a low time frame. So you can trade in pullbacks, but that is considered counter trend, remember, okay? But in order in terms of where to target, I wouldn't really have a set target just because you should take what you should get. Remember at the end of the day, guys, the market owes you nothing. You'll always leave money on the table. Those two things, you need to always remember that. You'll always leave money on the table and the market owes you nothing. So take what you can, okay? Especially when you're trading counter trend. Don't expect to try and, if you're on a counter trend trade here looking to sell, don't try and target the high time frame range high or low, because remember, price is still within a bullish range. Sometimes it might go on a target and take out that low and flip bearish and you got lucky, but just don't be greedy, just be pragmatic. I don't like the word realistic, so I'm going to avoid the word realistic because I think that anything is possible, but I'm going to avoid that word because I don't like it. So I'm going to go with pragmatic. So, but just be pragmatic when it comes to TP or take profit placement. Now, what I'm going to do is, guys, with everything that we just discussed, I'm going to give you guys a trade recap. But so far, I just quickly wanted to take a minute and just say, guys, I really hope you've took some value away from this. There's a lot of information that I've shared, and I really really recommend you jump on the charts and really put this into application. Just apply it to the charts and let me see. Share your charts with me. Put it in the chat. Ask how you're doing. I might not reply, but a student of mine might reply. Okay, if you're in the mentorship, guys, I would definitely reply to you. Okay, if you're in the group, so get involved. Have a mentor that you can look up to, because if you can have a mentor that's got real experience like myself, like, guys, I've been trading for almost a decade. I've not just spawned in out the past year or two. I've been here for a long time. A lot of people, your so-called mentor or guru, they probably know me, or they most definitely know me if they trade a similar way to me, because I've been around a long time and I've probably taught them as well. There's a lot of people I've taught in the past and done one-to-one sessions with. I do one-to-ones as well. If you are interested in that, make sure you send me a message for that as well. But I've taught a lot of people that have had one-to-one students in the past before as well, that I've gone on to teach other people and start up their own groups. I mean, it's up to them what they do. I don't really care, but a lot of these people that you look up to and call mentors, I've actually mentored them. I don't want to be cliche and say, well, I'm the mentor's mentor, like some cliche guy would say, but I've taught a lot of these people out there on social media. But I got really experienced guys. I've been training for a long time, and I just really wanted to teach you guys a no BS or no bullshit approach. Excuse my French, but a no bullshit approach. But yeah, we'll jump onto the charts. I'll show you a trade recap. Okay guys, so now we're on the charts. We're going to be going over the euro dollar. I'm just going to go over this trade and I'll show you guys what I did was and explain the process. This is a trade I'd taken on the 25th of June. Beautiful trade, to be honest, very textbook. So very simple guys. Okay, now as you can see here, this is a short-term sort of move. I wasn't really looking to hold it on to these new lows or whatever. It was just a very short-term move. Okay, we tapped into a H4 supply zone or order block. But I just refer to them as supply because I've, if you're on my mentorship, you'll know that I've very simplified my trading. If I'm looking to sell from a POI, whether that's a breaker or a block or imbalance, I refer to it as a supply zone. Okay. Vice versa, I refer to it as a demand zone if I'm looking to buy from it, just because I'm trying to simplify everything that I do in my trading. Anyways, as you can see here, guys. Okay. I'm very known for the Asia trading, the Asia session trading. That's something that it's one of my go-tos, my bread and butter. I'll give you guys my entry, one of my favorite entry approaches is a liquidity sweep, a shift in structure, a slight pullback, and then obviously a low time frame, confirmations, entry model, etc. Candle confirmation, that's something I spoke about on my YouTube as well, how to increase your win rate or candle confirmation. So go ahead and check that out. But that's sort of my go-to setup. Liquidity can come in many forms, and one of my favorite forms of liquidity is the Asia session. I've done videos on that as well. But as you can see here, guys, it's very, very simple. I'll just go over this trade for you guys. I've got multiple trade recaps, more trade recaps if you want to go ahead and check them out. But as you can see, there's a 4-hour zone that you just seen. The 50-minute zone is also refined from this wick supply here as well. You can refine zones up into the wick there as well, a little tip. We also swept that liquidity, so the Asia highs were swept there very nicely. And then as you can see here, we had this range high and this range low. Now, price had chopped to the downside. We got the shift here. And obviously price had, we haven't formed the new low at this point, but we pulled back into this previous demand zone that has now turned to a supply zone, so also a breaker. As you can see here, we get a nice wick mitigation into the breaker for the slight imbalance there as well. And then all we simply do is just remember my targets. My targets were the overall M15 lows, and I did take partials around this Asia lows as well. So when we jump straight to the 1 minute, as you can see, my entry here was very, very clean. I had waited for price to pull back into the M15 supply or breaker, and then obviously as you can see here, we chock here. We can also look for an entry here as well previously, but that's just an extra mitigation for an extra confidence for the trade. Anyways, as you can see, we break structure above here, we get a new high, break again, break again. We have this high, we have this low. We then chock ever so slightly here to the downside. We have this new low, we have this previous same high. We then pull back into this imbalance, and which is my supply zone from this high to this low here. That's my whole area to sell from. We tap into that there, we get this wick rejection and engulf into the downside, which is my candle confirmation. And that there is a trade. I had my stop loss above the M15 zone. You could have gotten away with it above the engulfing for a very more aggressive stop loss placement, or above here, so for sort of midterm. But if you're being pretty a patient trader, and you focus on the long-term process, and obviously also about there, be pragmatic. Okay, and then my targets were obviously at the overall M15 lows that you just saw, guys. Took partials of this area, and it was a total of 3.74%. So that was a beautiful trade. You can definitely go ahead and study this if you want to, guys. 25th of June, Tuesday, just before 8 o'clock as well. So again, you got market timing behind it as well. You've got breaker mitigation. We swept that liquidity. We shifted to the downside. The range was bearish. We mitigated that breaker. We chopped on here on the M1. We filled in balance in the M1. We got a nice engulfing candle there as well. So that there is a very beautiful trade. That's sort of my go-to setup. That is something I'd love to trade every single day if I seen it play out every single day. Obviously we have to adapt on a pretty daily basis, because not every setup would be like that. but that is, you know, one of my favorite bread and butter setups. But that's pretty much it for this trader recap, guys. I definitely recommend you go ahead and check that out. I've got multiple trader recaps and a lot more out there if you want to go and check them out as well. There's loads out there of mine, especially in the ZCFX mentorship. There's loads. But yeah, let's just jump straight back onto this. We are pretty much nearly finished now. I know we've been in the video for a while, but moving on, I want to give you guys a little bit of homework for you for this video. So for those of you that have really watched this video, I really want to see some homework, and not homework and like, you know, some maths tests or whatever, but all you need to do is pull up a chart, any time frame, any trading asset, map out the range highs and lows, map out the structure breaks, and post your results in the Discord chat and tag me or send me a direct message. And if there's any corrections needed, I will let you know, or someone else will. If you're in the Discord community like this, my mentorship, my private group, then even better. You'll get a lot of more support in there, but I don't mind looking in the public chat every now and then and seeing if there's any homework as well. But yeah, just do that. For example, pull like Euro USD daily time frame or Euro USD 4-hour time frame and just mark it all up within, you know, from whatever's on your chart. So if I just go on the trading view and I click this, double click the sides, I'll see all of this, and then just mark out everything within that. Okay, and then obviously when you post it, just give me like the date of it, so that whoever's going to correct you, if there's any corrections necessary, we can correct it. But yeah, you can contact me as well on Discord as well. But yeah, moving on, I just quickly want to go over, guys, some of my recent student success. There's literally we get success on a daily basis. We get feedback and reviews on a daily basis. So if you want to see more of the student reviews and, you know, feedback and testimonials, go ahead over to my Instagram page there and check out my highlight community. There's a lot of information in there, a lot of, you know, feedback, a lot of students who have become profitable, a lot of success stories. Really, it really is. We are seeing student success day in, day out. Again, guys, if you want to see more testimonials or feedback, please refer to my Instagram page, so you can see how many people's lives we're truly changing. Guys, this is something I've been waiting to release for a long time now. It is the brand new mentorship program. It is finally here. I will leave a link below this video to go ahead and check out all the information on there. But guys, I'd really recommend you check it out. It is going to be life-changing for many. Not only have I seen already life-changing results, but this one, we've created it. We've got a roadmap with it, and for the first 7 days only, guys, this is going to be available. So use code Masterclass on checkout. The price is a one-time fee of $369. We've completely scrapped the monthly options. I mean, don't get me wrong, if you do want to pay via monthly or quarterly, then contact me and I'll sort you out a payment plan to do that if you can't afford the 200 up straight. But guys, £200 for, or £199 for what I'm about to teach you guys is truly incredible. I definitely recommend you go ahead and check it out, guys. There's so much valuable information out there. So let me ask you guys, if you want to become, if I was going to ask you now, do you want to become a consistently profitable trader within 12 months and get your first payout from a prop firm? If yes is your answer, then start wishing and start doing and join the ZCFX mentorship, guys, because the answers are all in there. It is your final stop, your last stop for success. I've revamped it all. It's a brand new program, and I will be doing some deals as well throughout. If, for those of you that join, you can get access to one-to-one on a video call as well within the Discord. So you know, make sure you go ahead and check that out. But guys, if you have any questions, things like that, you can always reach out to me. I'll jump onto where you can contact me in a minute. But use code Masterclass and get yourself £200 off, guys. It's an amazing and big discount. It's the only discount I'm going to be doing for this. I probably won't be doing any other discounts, to be honest. Maybe some on Black Friday for like, what, 5 or 10% off, but £200 off, never ever going to do it again, guys. So use code Masterclass if you are interested. I'd strongly urge you to look into it, or if you need more information, guys, just shoot me a message and I'll send you some more info. But go ahead and check it out. The link will be below. And again, guys, contact me in case you want to reach out to me, whether you have feedback about this masterclass, a question, any issues, or you just want to chat and say hello. Shoot me a message and I'll help you guys out. Okay, contact me directly through Discord or Instagram. Just beware of scams if you are going to contact me through Discord or Instagram. My Instagram account is ZCFX Trading. There's no catch to it. There's nothing else. There's no dot. There's no underscore. There's no random different letter. I am verified as well. I currently got 113,000 followers. on our Discord as well. Make sure you go ahead and just click on the person who sent this video into Discord. Just go straight through that name. I won't reach out to you first. I won't add you. I won't try and get you to invest into anything. So just beware of general scams and things like that. Or you can email me personally over at ZCFX@gmail.com. I'd recommend you do that as well, just to be on a safe side. But you can email me. You can contact me through any way you want, and it can be from issues. It can be some homework you want to submit to me from this video. I'd love some feedback, to be honest, guys. I really would. I've not really done. I've done webinars in the past where I've spoken about supply and demand, things like that. But I've not done a masterclass like this, especially in years. It's been years since I've done this sort of style of video. It's been like an hour long. So I just sat here for an hour straight and just pumped this video out. It's just all raw. There's no script. It's just whatever's on the presentation is straight onto the charts, raw, and pull up a random chart. But that's how real I am, guys. I'm not here to mess about. I'm here to teach you guys the real way and the real profitable way of trading. So guys, please check out the mentorship. This new program is going to be life-changing. I promise you, if you just stick to it, it's going to be insanely valuable and life-changing for you. Guys, please let me know how this video went. Watch it multiple times. Watch it back and back if you need to. And get a notebook, okay? If you watch it the second time round, you'll learn even more than what you did on the first time round. That's just how it is. The same with reading books. You pick up on more things on the second time round than you did on the first time round. Hell, even on the third time round if you're that dedicated. Guys, this is going to be Luke, and I've enjoyed this video. I've enjoyed making this video. And any questions, guys, you already know what to do. I'm going to stop waffling now. I'm going to head out. I'm going to have a nice time. I'm going to celebrate. And guys, I'll see you on the inside. Do not miss this opportunity out, and do not miss this discount out. It's available for 7 days upon release of this video.